Well, 2023 was a stupendous year for the stock market. The question is, can this momentum continue into 2024? What are major brokerages saying? What are the stocks and sectors and themes that they are betting on? Well, we have Nimesh standing by because he's been pouring through a lot of the strategy notes that have come in as the year kicks off. And he is getting us some of the most interesting highlights from the same. Nimesh.
After a stellar 2023, all eyes will be on 2024. Can the momentum continue, or is this time to be cautious? Let's find out what are the top FI brokerages are betting on for 2024. Let me start with Jefferies first. They continue to like the domestic cyclical. So they like power, bank stocks, industrials, telecom, as well as the property sector stocks. Now, while they continue to be underweight on IT, consumption and energy stocks, they've raised banks to an overweight in their model portfolio. In fact, in the large cap names though, they've trimmed a bit on L&T and they've added Adani Ports to their model portfolio. Now look at Bernstein. They say that it's the time to book profit. In fact, they've downgraded the small and mid cap sector to an underweight relative to the Nifty, given that they're finding very difficult to justify the valuations for most of the mid cap stocks. Within the sectors though, in IT, they've upgraded IT services to overweight. However, they've downgraded the consumer tech to equal weight. The other sectors where they're bullish on, they've upgraded telecom to an overweight. They've marginally upgraded metals as well to equal weight, and they continue to be overweight on the healthcare sector. While they're bullish on the cycle though, in the broader universe, they've downgraded a bit on real estate as well as in the cement sector in the model portfolio. Now let's look at what Citi has to say for 2024. Even they say that the risk reward is very unfavorable in the small and mid cap, and they are preferring the large cap. So within the large caps, they're overweight on PSU utilities, they're overweight on defense, they're overweight on industrials, as well as in the insurance sector. On the other hand though, they're actually underweight on IT, consumer discretionary, and the metal names. But interestingly, they've put out 5 contra bets for 2024. Those includes the likes like HDFC Bank, Cipla, Devyani International, Indus Tower, as well as Endurance Tech. So these are the top 5 bets for Citi in 2024. So looks like while 2023 was a year of mid cap and small cap, 2024 could be the return of the large caps.
Thanks a lot, Nimesh, for that. Let's get straight to talking to Venugopal Garre of Bernstein. Venugopal, thanks a lot for joining in. So there's clearly some amount of caution in your note. Take us through that. Why are you cautious on the Indian markets?
No, that's right. Given that the market is just about to open, firstly, Happy New Year to all of you. Yes, my broad, quick answer to that would be that we are probably reaching a situation where we're hitting onto a valuation ceiling. Look, this has nothing to do with being negative on macro or on earnings. It is primarily a situation where we are actually calling to take profits. That's basically what we've been arguing in our Outlook report as well.
Venugopal, thank you very much for joining in. Season's greetings to you and wish you a very, very happy new year. Now, you are calling for a bit of sobriety, right? I think you're looking at 8% return this year, and you're telling clients book profits. Tell us why. Why the caution? Is it simply because of the run-up that we've seen, a very strong run-up in the last 2 months? Or do you see any other risks or red flags out there?
Yeah, so I think this book profit call is clearly not consensus. The fact that even after releasing this report on Jan 1st, I've had conversations with quite a few investors. I don't think investors at this juncture are too worried about both the macro and the earnings landscape. But the reality is that the fact that everybody across the board is struggling to figure out how to eke out decent size returns on India at this juncture. Now, interestingly, this is not just a challenge that portfolio managers are finding. This is a challenge which even analysts would find both across sell and buy side, and in terms of a struggle to see how to increase their target prices. So believe me, you'll see a lot of creativity out this year in terms of trying to figure out how to generate more returns. But the reality is that valuation ceiling is fairly intense. Now, if you were to think about it, earnings growth this year is fairly decent, broadly a mid-teens clip for the headline indices and probably higher for SMIDs. But the reality is that are we going to see earnings upgrade this year, especially in a year where macro is decent but not necessarily going to see an incremental positive momentum compared to what we saw last year, because last year was on a low base, right? So we swiftly moved up and quite rapidly moved up. So earnings upgrade cycle doesn't look like the case at this juncture. Decent earnings though. The second thing is primarily that if I were to look at it, a lot of the positives, especially around the rate cuts, which are expected this year, both from a US perspective as well as potentially from India. We're also seeing a situation where broadly there is a political certainty expected, and especially after the news flow post the state election results. That's also something which is priced in. So these are the positives, which essentially, in our view, are priced in. See, purely very quickly from a risk standpoint, the reality is that risks don't really announce themselves. They keep looming around somewhere. You just need to figure out whether those risks basically translate into a reality. For me, the simple things primarily are that a premature interest rate cut, in my view, would be a mistake. And that's primarily because it's going to revive inflation fairly quickly. And this I'm talking about global perspective. India's rate cycle cannot create any inflation. It's basically about what happens in the world. So that is something I would worry about. Number two, El Nino is still a risk from a point of view of monsoons and what it does to rural sort of economy. Number three, primarily would be the fact that US, there is still a lack of clarity on where they head in terms of economy. Now, if there is a rude shock or a sort of a really big shock out there, that's sort of something which is not priced in. More importantly, there are wars going on. We don't know what happens to that, but these are like the outer cases. So there are some of these sort of macro global risks which are looming around, which we need to acknowledge.